Howdy, Jacob here. Today we're looking at the company Aptiv in the automobile components industry. 22.6 billion market cap on 26 billion enterprise value. So we are looking at a little bit of net debt here. They design, manufacture, and sell vehicle components. And the growth has not been extraordinarily sexy. 15.5 billion in 2014 to 20.0 billion in 2023. And that's inclusive of the last 3 years being very heavy increases in revenue growth due to the used car demand wildness post-COVID. But gross margin actually down a little bit and operating margin down a little bit. So not exactly what I'm wanting to see here. Return on invested capital also down a little bit, but is averaging in the low double digits. So that is positive. They're still likely above their weighted average cost of capital, increasing the business. Or creating business. Balance sheet shows 1.6 billion cash on hand, 6.2 billion long-term debt. That 6 billion long-term debt is about 5 to 6 years. Okay, yeah, this is another one. The other is the capital expenditure. So we're looking at maybe 700 million there. So it is about 8-9 years of their 5-year average free cash flow, which is a good amount. That's a lot of debt in comparison to the free cash flow coming into the business. And it looks like they just, whenever there's a big net acquisition, they do increase their debt. But their use of free cash flow, mostly acquisitions, a little bit of share repurchases, and then a dividend that is currently not being paid out at all. It's down to zero. But most use of cash is share repurchases and acquisitions, but the company has a lot of debt. So we're going to have to balance out in our projections what we want the company to do with what they've done historically. And with a company that has 8 times their 5-year average free cash flow in debt, we're going to want them to use a good amount of their free cash flow to pay down that debt, which is going to hinder these other assumptions, such as revenue growth, because they're not going to be able to reinvest and make acquisitions, and then possibly the margins due to not making those efficient acquisitions and such. So on the revenue growth side, I think that probably even with all the heavy growth recently, we can grow maybe a little bit more than inflation, say inflation, and then maybe a little bit from acquisitions. Terminal PE, I don't think should be very high. I mean, they have bought back shares, which does inflate their return on invested capital figure as the denominator decreases, that increases your ROIC. And so I think I'm fine with maybe 12 here because they do have a little bit of net debt, and I think it's not as great as the average company personally. And then for margins, pretty big range. I don't like that. Free cash flow is lower, but let's just do something like that with a share change of 1% would be about 200, 300. Okay. I don't know. Let's keep that flat, actually. So we're assuming that they basically use 15% of the free cash flow to repurchase shares. We're assuming maybe 15 to 20% to acquisitions and reinvestment. And then we're leaving about 50% of free cash flow to reduce that debt. And so with those assumptions, these are the predictions of revenue growth, margins, and such I make. Because again, you have to balance out what you think the company is going to do with what you want them to do. And so could they go into more debt? Absolutely. Could that increase growth a lot more? Absolutely. But it's going to make the company riskier. And to me, that's not the best way for them to proceed. But anyways, I do hope you enjoy the video and have a great rest of your day, because we get to a stock price that needs to fall 65% to get to the price we're looking for. So I would just be waiting for this company to drop to do more research. Thank you.